Hello and welcome to a brand new episode of Smart Money. Now, the big event to watch over the next 6 to 8 months is the general elections 2024 that will be held in April next year. Historically, the run-up to general elections has been a good period for infrastructure and capex-related companies since a lot of government spending generally happens in the run-up to the elections. Today on Smart Money, we're going to discuss just that. We have Gurmeet, Chadha of Complete Circle Consultants right here with us in the studio. And the question we're asking is, are we witnessing a repeat of the 2003 to 2007 investment cycle? And if yes, what are the stocks or sectors that you need to play this theme? Gurmeet, thank you so much for being here with us in the studio.
Thanks, Sonia. And, so the reason we chose to discuss this was, one was the data which was coming. And second was the on-ground feeler you get when you travel. So I've been traveling to places like Ludhiana, Nasik, Nagpur, Faridabad, NCR places. And, there's some lot of work coming to MSMEs, right, from the larger OEMs. And then we try to, collate it with data. So if you see, for example, the gross capital fixed formation is almost 30% of GDP. Now, to make it simple, this is basically the new and existing assets you add minus the what you dispose, both at government, company, and household level, which tells you that business activity is picking up. Then we figured out, we tried comparing it with 2003-07 to now. So the corporate profitability in 2003 to 7 went up from 2.5% to 5% of GDP, right? The capacity utilization went up to almost 80%. The new projects awarded by banks all went up. So if you see now, from FY20, we were 2.2% of profitability to GDP. We've gone up to 4, so we are probably at the midpoint. The capacity utilization now is almost 75%.
Okay.
Right. So I'm just saying these are early signs. I don't want to jump the gun and say that we are exactly in that cycle. And probably this will be more long drawn because the world is not what it was in 2003-07. But all the trends, you see the figures coming from private players like L&T, etc., tells you that this, the investment cycle is kick-started. Started by the government, and now I think the private sector is
getting into it. Yes. Okay, so let's talk about the different themes, right? And I'll just request my director to get the themes up on board because we're going to discuss some specific themes in this investment cycle. And here we have it. These are the big themes that we're looking at, right? There's capital goods, there's power, cement, utilities, infra, PSU banks, as well as the home improvement theme. So let's go one by one, step by step. The first theme is capital goods, and we discussed this ad nauseum that, capital goods as a sector has not performed for over a decade. What makes this time different?
So, three things, right? If you see, for example, the commentary from, let's say, L&T, which is the largest player, right? It's up the tender pipeline to 10 lakh crores. It started the year with 9.7. It's already guiding for exceeding last year's guidance in terms of 4 lakh crore is the current order book. Now they're getting orders from hydrocarbons. So if you see Saudis, they have a clear plan of 2030. So whenever oil goes up, they want to use that to get to non-renewables, right? So huge orders coming. We saw $3.8 billion from the Jafra field of Aramco coming to L&T. Then, the private orders are 20% of the book. It was just about 10-12%. So it's not just confined to, and all segments, infra, power, hydrocarbons are firing for it. I also believe there will be better ROE accretion from 12% to, it will start reflecting over a course of time.
But it's already performed a lot this year, right?
And L&T outperformed everybody else in 2003 to 7, right? So when the cycle starts, see, you have to play the secularity of the opportunity, right? So if the opportunity is good, you have to then see that how the industry's profit pool will go up, the order pool will go up. So you can start with, let's say, L&T, but you have to really go down the value chain and play the sector well.
Okay, so L&T is one of your first, themes that you're looking at. First stocks within this capital goods theme. Any other stocks that you like within this space?
Yeah, so, quite a lot we like in this space. One of them, I think, is the railway has been a huge capex driver. So in last 4 years, the railway capex has doubled. The spending by the government has doubled. And while there are different plays, there are railway financiers, there are different. We like one company more from the, again, as I said, the size of the opportunity. So we like Titagar, So they are the leader in wagons. So now they are expanding capacity from 8,500 wagons to 12,000 wagons. They are also beneficiary of Metro and Vande Bharat. So they are expanding the coach capacity from 250 to almost 800, and they are getting a lot of international orders. And they've also got into forging wheels, right? And there they have a tie-up with RK Forgings. So their order book right now is 10 times sales. So FY23 order book is basically 10 times sales. Valuations are rich, but then that gives you basically a visibility of how it's going to, play out over a period of time. So that's the second one we like in capital goods space.
Okay, so there's L&T, there is Titagar. These are companies that I think are well discovered this year as well. So you're saying that this is a structural upcycle. Even if these stocks have rallied 30-40%, it's not too late to enter them even now, right?
See, also, market has a bad experience. See, EPC, capital goods is a very selected play. The balance sheet has to be strong, your working capital has to be good, execution has to be, you can't just rely only on the order book. Those stories have played out very badly in last 10, 12 years. So, once you become the preferred, you can call it L1 in case of L&T, you can call it other terminology, then you have to go with the ones who have a solid track record.
And there's ABB India on that list.
Absolutely.
That wraps up the discussion on capital goods. Quickly on ABB India, if you want to take us through what the big trigger is.
Again, as I said, if you hear the management, they're talking of, 15% plus kind of revenue guidance, very good expansion plans as well, solid balance sheet strength, good pedigree. As I said, so there are a lot of road developers, you remember, Sonia, shot up when there was sudden expansion in road, and markets had a bad experience as well. So ABB again is industrial recovery as well as the overall, investment cycle recovery for us. Okay. And good parentage as well. Yeah.
Okay, absolutely good parentage. That's the capital goods space. Let's move on to theme number 2, which is the energy sector. And I want to understand a little more about this because renewable energy power has come back in a big way. So for people who've missed out on this theme, how do they optimize here?
So, clear trend. So, power, I think, is a proxy to your manufacturing picking up, consumption picking up. So, if you see August numbers, we were 264 gigawatts, which is like 16% more than last year, August. If you see September first fortnight, we are 23% up on power. So, clearly, and if you see David Solomon's speech day before, he suddenly switched gears and talking of, even traditional sources of energy, secure energy. So, all that ESG thing, which plagued the sector, which made a lot of these companies, out of favor because of, traditional fossil fuel sources, are suddenly coming back. So the world is now realizing because of geopolitical tension that the path to renewable is also long drawn, right? So I think that ESG thing is probably making way for more traditional guys. And, as I said, this part has been completely ignored in portfolios. So I'm not saying you should have all this portfolio. I'm saying, but because this portfolio part is so missing in portfolios, it makes sense to add. So we like Tata Power. Integrated play from generation to transmission and all. So they have a clear goal of doubling revenues to 60,000 crores by FY25. Okay. 20 gigawatt goal on renewable energy by 2027. Solar EPC, very large player. They have like 12,000 crore revenue guidance there. EV charging. So they're playing the complete, and at some point of time, I think there'll be some value unlocking with renewable energy probably getting hived off at some point of time, the way, they are taking it up.
And what about the valuations for something like a Tata Power? I ask because it has been, once again, a big gainer this year.
It's not really gained much, actually. So if you see the last high was 320. So it went down to like 180. It's currently midway around 250 or 30 times. So it's not like really cheap because some of the run-up has happened. But as I said, I see the size of the opportunity, really large, justifying that kind of
the run-up. Okay. Yeah. So that's Tata Power. In this energy theme, any other stocks that attract you?
So we like JSW Energy now. So almost 85% of the portfolio is now under long-term PPAs. They've got the balance sheet better now. So debt equity ratio is down to 1.5. They again have a goal by 2030 of 20 gigawatts in terms of their expansion capacity. And they are making moves in renewable as well. So that's the second one we like. In this particular space.
Okay, so the other theme that we are looking at is the cement industry, right? Yeah. And generally you notice that when infrastructure picks up, when real estate picks up, cement obviously is an ancillary that picks up too. And now we are hearing that even pricing is going up, yes, especially in regions like the south. Yeah. So which are the biggest beneficiaries of this?
So I think you have to play through both a large player as well, let's say a turnaround story in case there is one. So Ultratech, I think, is clear beneficiary. They are 132 million tons on capacity. They're coming up another 22 in central India, which again will be a beneficiary of pricing being better. The debt has come down from 22,000 crores to 3,000 crores, so hardly any debt now. So it will give you a perfect operating leverage and financial leverage. They spoke of 90% capacity utilization in few months. In fact, it touched 100% in 1 month. So perfect operating financial leverage, large player. And 80% of the incremental capacity is now coming from top 3 players. So the industry will also consolidate. So we like Ultratech. And the one we like more is now is one of the turnaround stories. It's a risky bet, small cap company. It's called Sagar Cements. So one is valuation. It's available at $50 a ton. So that's below replacement cost, right? So if you Ambuja just acquired Sanghi at $100 a ton. So this one is $50. One of the lowest cost producers of cement, almost 12-15% lower than the peers in South. And I think should probably become cash positive next 2 years. And after Andhra's acquisition, they have like 11 million tons. Right mix of OPC, PPC, almost 50-50%. So that's the other one we like.
Okay, so there's Ultratech Cement and there's Sagar Cement. So let's try and just rewind all the stocks that we've talked about so far in case you've missed out on any of them. There's L&T, there is Tata Power, there's Ultratech Cement, Sagar Cement and Titagar Wagons as well, along with ABB India. So these are, of course, in the capital goods theme, that's the focus area, L&T, Titagar and ABB. In the energy theme, there's Tata Power and JSW Energy. In the cement theme, there's Sagar Cement as well as Ultratech Cement that Gurmeet likes. So these are a list of stocks. Of course, these are not stock recommendations. These are purely for, learning purposes. You need to take your own call on whether you want to invest or not. But this, of course, will help you to understand what the prognosis is as far as growth for these companies is concerned. Let's do one thing. Let's take a short commercial break. Many more themes and stocks lined up in just a bit. Stay tuned.